John Jagerson here with Learning Markets. I wanted to be able to take a very close look at the charts. So we're going to be spending most of our time here looking at the charts. Right now we're looking at the SPX. This is the index for the S&P 500. So it's a nice broad market index of what's going on with equities. And we're going to be looking at a particular technical formation that is one that is a favorite amongst technical analysis, or analysts rather. And technical analysis is a really useful form of analysis. It's not necessarily better or worse than other methods. There's a lot of good ways to look at the market. But one of the reasons why technicians like to use it is that it encapsulates the price should be encapsulating basically everything that's known about the markets today in the context of what traders are doing about that information. So this is one of the reasons why technicians tend to focus on technical analysis to the exclusion of things like fundamental analysis. And I have an interesting website to actually show you, written by some real fundamental analysts out there that wrote about this particular formation that we're going to be looking at today that I think you might find very interesting. So specifically what we're looking at right now is the rally that's been going on in 2009 from March through July in equities, so as represented by the S&P 500. And one of the questions that investors are always asking is, well, how likely is the trend to continue or reverse? And we look for price patterns to give us a little bit of insight into, is the market consolidating? Is it likely to reverse, or is it likely to continue? And right now we're seeing a real classic formation. It's a head and shoulders pattern. I'm going to draw some marks here so you know exactly which parts of that formation we're talking about. As you can see, I've put a little S and an H and an S over this head and shoulders pattern. The pattern itself is basically three sequential highs or peaks in the market, the tallest one being in the middle of the other two, hence the name of the pattern. And as you can imagine, the little support line underneath the bottoms that preceded and then followed the highest peak, or the head in this particular pattern, is called the neckline, as you can imagine. Now, once the neckline is broken, which occurred earlier this week, so this is 7/7 of 2009. In this pattern, it doesn't matter when you're looking at these patterns. They form in all kinds of markets at all times. But this is the way we would start to analyze it. It's not uncommon for the market to retrace a little bit and begin bumping up against that upper line, which has happened to a certain extent today as we're looking at this right now. We're just coming up to this line, beginning to bump up against it. Now, the question remains, well, if it's an important technical pattern and it indicates a very high probability for a reversal, which, you know, as with technical analysis is a lot of fun. Just like any analytical method, you are wrong quite a bit. There's nothing that's 100%. But when you're right, you're really right. This is why technicians really like this particular form of analysis. But where do we think the market may go? So assuming that in the next day or two it does bounce off this neckline and begins to turn down towards the 800 level, will it get to 800 or 750? Is there a way to make reasonable estimates about what we think the market should do? Well, there is. There's two very common approaches. They're both relatively simple and they're pretty easy to do, and was one of the reasons why I wanted to just look at the charts today. So the first thing we would do is measure the distance from the neckline to the top of the head. So if we do that, I'm just going to draw a line from the neckline to the top of the head with my little drawing tools in my charting application. This is the same thing that you can do on your own. Now I'm going to take that line, I'm going to drag it to the breakout. So I'm going to attach it to the bottom of that neckline as we're looking at the breakout that occurred here recently, and it gives me a pretty good estimate for where I think prices may go, start to bottom out and begin to consolidate again, which is in the 820 range. So we have about 60 points on the S&P here that we're looking as a reasonable near-term estimate for how far this correction, should it occur, which we think is likely based on the technical pattern, how far it's likely to go, at least in the near term. Now, there's another way to approach this same problem, and that's by using a Fibonacci retracement. And you'll find that it actually does a pretty good job of approximating the analysis that we did here, which is very similar to a measured move, or the concepts behind a measured move. So we're going to attach the Fibonacci retracement from the bottom of that rally that got from the bottom of the shoulder to the top of the head. and we start to look for our retracement levels, 161, 261. You'll notice our 161 here, not that far off. We're about 15 points away from our original projection. So we're within about spitting distance of what we think the market is likely to correct to. So this is what a short-term trader would be looking at. If we begin to break the 161.8% retracement level here in the near term, we would start to look for the 261.8% retracement level. Let's look at another chart where we can see what this pattern looks like when it completes. Now I've switched markets here as we look at the head and shoulders pattern that's completed and was actually quite dramatic. I think it is a great textbook example of what this pattern looks like and what we expect from price movements following the pattern. This is the pound-yen exchange rate, which had been on a run for several years. And on the weekly charts, which is what we're looking at here through 2007, began to form this classic head and shoulders pattern. You can see it here. Shoulder, head, shoulder. And if we draw a couple of lines, we can draw a line right across the bottom of this neckline. So we're going across a couple of extremes here. We got this neckline going across, and we would say, all right, it broke out here on 1/5/2008, so the early part of 2008. And we can start to make some projections about, well, how far do we think it would go? And we can do the exact same thing that we did, that we're doing currently on the SPX. So we draw a line from the neckline to the top of the head. We can project that down, and that will give us our first or an initial estimate. We can also do something very similar with the Fibonacci retracements, and I'll show you why I prefer them over a more doing the measuring like we did here with the distance between the neckline and the head of the pattern. If we zoom out a little bit here, you can see that, so we can see where that, so our initial target took us all the way down here to 185. But the Fibonacci retracement in this case was a little bit shallower because we had this downward sloping neckline. So that's going to make this, it's going to make the difference between these two measurement methodologies a little bit more pronounced. But you can see right there at the 161, we get a much more reliable consolidation. So it was a little bit better estimate in this case. Now, if we go back even further and begin to see, well, how did this continue to play out? You can see we eventually went back and retested that neckline. Let's extend that neckline out. We're going to grab this anchor here, and if we drag it out, you can see we came back, we retested. It's something we're looking on a shorter time frame to happen with the S&P 500. Retested it and began to break down. Ultimately, each of these Fibonacci retracements become candidate support levels. So here in the beginning of 2009, we get the bounce that we were looking for at 423.6%. Now, this was a dramatic change in the market. This is a very significant change that reflected the global economic crisis. So it's an extreme example, but I think it's a good one for traders who are new to technical patterns to analyze and begin to evaluate the patterns that they're seeing on a day-to-day basis against kind of this best case textbook example. We're back looking at the head and shoulders pattern here on the SPX. Now this matters for equity traders who are certainly going to be interested in controlling their risk because they see a very important signal that the trend is seriously weakening and could be in danger. So you'll see a lot of equity traders beginning to trade at the money or even slightly in the money covered calls against their positions, providing a little bit of a hedge there, or potentially taking some risk off the table by buying protective puts. So it still leaves their upside unlimited, but they're giving up a little profitability for downside protection. Both of those concepts, by the way, you can learn a lot about for free here on Learning Markets. So I put some links in the article to be able to learn a little bit more. But we can also transfer this information into the intermarket environment. So accompanying this breakout, this head and shoulders pattern breakout that we're seeing on equities, we can take a look at, well, what's going on with other markets that are sensitive to the same kinds of factors that the SPX is. So for example, here we're looking at an index of the 10-year notes yield. So this is the government 10-year note, and it's going to move in very similar ways to equities. So if equities, in fact, do begin to decline, well, we could do a couple of things. Either we could speculate to the downside on yields. There's puts available on this kind of thing. Or we can go long bonds, because if yields are dropping, well, bonds are the inverse of yields, so they're going to be rising. So those are ways in which we can start to adjust our portfolio allocation a little bit when we start to see patterns like this emerge. Similarly, out here in the Forex, the dollar-yen exchange rate is very sensitive to the same kinds of risk issues that equities are sensitive to. And as you can see, this week has not been a good one for the dollar-yen exchange rate. So it's been good for the yen, bad for the dollar compared to the yen. And even despite the big move on this particular Forex pair, if the pattern in equities continues to complete and we begin to see further declines, we would expect to see something similar here on the dollar yen. So we could see even additional downside. But it's all using the intermarket to try to identify what's going on in the intermarket and to take trading signals from some place like equities where we have a very clear price pattern and apply that to the particular market that we may be interested in that's sensitive to the same things. It really broadens the how much data we're evaluating and can help us find some opportunities we might not have identified otherwise. For those of you who are interested in technical patterns, we have a couple of recommendations. I'm going to get to this website we're looking at here in just a second. The first would be the Encyclopedia of Technical Patterns by Tom Bukowski. It's an excellent book. It's well worth the time and effort to work your way through it. It does a really nice statistical analysis of price patterns and identifying them and helping to classify them. It's a great place for new and experienced traders to get more familiar with technical patterns out there and to begin working on their expectations of those patterns. Additionally, this is an old paper, but it's available from the Federal Reserve Bank of New York. Now, these guys are real fundamentalists. They're not really technicians. But this is a great paper. The definition that they used for Head and Shoulders pattern is a little loose, so I think that you could probably see better performance with a more deliberate analysis. But nonetheless, they evaluated this particular technical pattern and came up with the title here, Not Just a Flaky Pattern. It generated above expected returns following trading signals based on that pattern just on an automated basis. So it's an interesting paper to read through. It should be particularly interesting to Forex traders since they actually tested it on exchange rates. So check that out. It's kind of it's a very interesting point of view to see a technical pattern review and analysis by an entity, this is the Federal Reserve, that's not known for its technical analysis. So it's a very interesting point of view, and I would recommend it as some fun reading.